It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Chinese stocks whipsaw on hopes the government may unveil fresh fiscal stimulus at a planned Saturday briefing. Bond traders, meanwhile, batting on further declines in the Treasury markets as they await U.S. inflation data out later. Plus, the man who transformed India's Tata Group into a global empire is dead. We'll take an in-depth look at the legacy of Ratan Tata. Taking a look where we are in terms of the stock market, we're seeing Asia getting a lift from that S&P, yet another record close for the benchmark, even as we await that CPI print on Thursday. That will likely influence the Fed's rate cut trajectory after that pretty strong jobs data. That inflation print is especially important. MSCI Asia Pac Index up 0.8%. S&P futures flat right now. We're tracking, of course, the benchmark in China. CSI 300 index currently up by about 1.5%, but it's been quite a whipsaw. It's posted its biggest drop in more than 4 years yesterday, and wide gyrations from that market as well as the Hang Seng currently up by 3.5%. In terms of the Chinese yuan, trading at 707.38, and the Japanese yen at 149.19, trading ever so closely to that 150 level. Well, San Francisco Fed President Mary Daly expects the Fed to be able to cut at least once more before the end of the year, with inflation coming under control. Let's take a listen.
What we saw in the last several months, really since after the first 2 months of this year, is that the labor market has downshifted. It's now at a sustainable pace of growth. We are just where I believe we need to be at full employment, not growing too fast, not growing too slow. And I am now quite confident that inflation is on path to hit our 2% goal.
All right, let's get perspective from Peter Kinsella, Global Head of Forex Strategy at UBX. He sees two more quarter-point rate cuts by year-end. Also with us is Bloomberg MLive strategist Mark Cranfield. Mark, let's start with you. Forget about, double 50 basis point cut. Now the question really is whether it was right in doing that 50.
Yeah, as we were just discussing in the break there, it looks like a bit like a catch-up play from the Fed, that they may have missed the opportunity in July, so they went extra big in September. And now the question is whether or not they can still do another couple of cuts before the end of the year. I suspect this week's inflation report will have a lot to say about it. Already we've had a jobs number, which is a little bit stronger than people expected. And that's why they're even questioning about the need for a full series of rate cuts from here. If we get an inflation print, particularly if the core number surprises on the upside, is really going to put the debate very much on the table for November. The Fed is probably not brave enough to refrain from moving, and they're going to go ahead anyway in November. The market is braced for it. They wouldn't want to upset the market too much. But December becomes highly questionable. If we do get a strong CPI number, they may give guidance that they've done enough for the year, and that's really what people will be trading this week. They'll be trading December more than November once the numbers come out.
And Peter, you say two more of 25. Citadel says only one more 25. Why two?
Look, I think if we look at what the Fed is telling us, they basically said that they would do two more. And I think that the cut of 50 that we saw in September was admission, probably tacit admission that they should have gone in July, so September was kind of catch up. But more broadly speaking, I think the Fed has realized it's basically behind the curve on inflation, right? And what we see is that pretty much every single subcomponent of the CPI index is falling, continues to fall. We've got headline pretty much back towards target and core continuing to come over. So, with a rate of 5%, that's still quite restrictive, right? Also, whilst we've seen, I would say, more volatile labour market data, some of the other sentiment data have been rather mixed. PMI data, et cetera, and ISM data. So when you put that all together, it suggests to me they want to continue easing, very nice sort of slow glide towards lower rates, but that would be consistent with the broader messaging that we're getting from the Fed. So I think 25, an absolute done deal in November. We'll see what the data looks like, but broadly speaking, nice trajectory, I think, of further rate cuts seems reasonable to me, given where we are.
Peter, you say that it is restrictive enough. Maybe some would beg to differ. If you take a look at where GDP is right now, above trend, we have the equity market at a record high. We have profits looking pretty strong. Some might say it is not restrictive enough.
Yeah, look, I think that the Fed would not be unhappy that we're seeing sort of some release of some animal spirits, and we're finally seeing some decent investment in the economy. I think that makes sense. But I think certainly if we look at from the Fed, we do know that policy works with a lag, and we do know with real rates of sort of 1.5% to 2%. I think that the 10-year TIPS yield in and around 1.5, 1.6%. That's reasonably restrictive, right? And we do know we're going to have to get some form of, I would say, budget agreement next year. We're obviously going to come in January with the fiscal cliff, etc. So look, overall, it suggests to me that some I would say reasonable rate cutting cycle is in line, and I think that's what I would expect.
Mark, if CPI surprises on the upside, would a pause be a possibility?
Yeah, I think December definitely becomes a potential, particularly as you've got another employment report as well to come in. You've got the US election. Now, it's not the Fed's job to make policy on an unknown election result. But clearly, if you look at both candidates, neither one of them is suggesting they're going to rein in the fiscal spending. That doesn't, in fact, if anything, it looks as though both of them want to spend quickly afterwards. So the US deficit is probably going to get worse going into next year. The Fed will be aware of that. They don't want to preempt it, but they will surely be thinking that the risks to inflation next year could be to the upside because of what's going to happen with fiscal policy. So although they won't implicitly say that, they may have that in the background thinking, well, if we get a couple of data pieces which say the economy is doing very well, it gives us the green light to at least take a pause and reflect on what's going on before we see more spending out of the US government.
So Peter, what does it mean for the dollar?
Well, look, I think the short-term dollar will be okay, just in the context that we're going to have the election obviously coming into November. I would imagine most investors would have a small long dollar position coming into that. Thereafter, though, look, you're going to have the Fed cutting rates, but in the context of this massive widening in the fiscal and indeed the twin deficit. And the last time we saw that constellation was kind of between 2000 and 2004. The dollar dropped by around 30% in that 3-year period, right? As concerns shifted from Fed rate hikes towards one of massive widening in deficits. The dollar is very, very expensive, and do you really want to be long the dollar from an asset allocation perspective ahead of a Fed rate cutting cycle with the dollar at multi-decade highs? Right, I'm not so sure that's a good idea.
It makes the G10 landscape pretty interesting for the last couple of months of the year. Is the euro the play for the rest of the year, or is it the yen? What do you reckon?
I would say more yen than euro. I mean, you've got basic divergence between the ECB and the BOJ. I think with Shiba, I think he'll basically leave the BOJ alone. They're going to do what they need to do, which is, again, gradual rate hiking cycle. For the ECB, I think it's more than likely we're going to see a rate cut. 25 bips in October is a done deal, in my view. There's a risk of them doing 50, but I would say at the moment they'll do 25. But it is clear to me that we're seeing, obviously, a much faster than expected fall in Eurozone inflation, but also the data in the Eurozone are awful. So, you're going to see further easing there. So if you have to choose between the euro and the yen as the best way to express a dollar short, it's the yen all the way, I think.
Of course, a lot of attention is on the US election, and some say, how do you trade this? Do you hoard the dollar, or do you play vol somehow?
Yeah, I would say vol. Hoarding the dollar, I said, you'll get it, I would say, depending on who wins, right? If Trump, wins, that would probably be initially small dollar positive, I would think. People are playing on tariff implementation and so on. But it's more a vol play, I would say. The thing is, though, if we look at it, it's just too tight to call, right? It's a proper 50-50 election at this point. And, the dispersion of outcomes is not exactly narrow at this point. So overall, I would say small dollar long, and again, playing it through vol.
And Mark, in terms of flows, what are we seeing as we count down to the US election, which is, by the way, less than 4 weeks away?
Yeah, I mean, as Peter was saying, we've seen a bit of a turnaround recently, people getting more interested in the US dollar. It certainly helps the fact that the Japanese Prime Minister essentially said to the Bank of Japan, don't do anything for the rest of this year, I've got an election to play. So it's put some pressure on the yen. You've also got China coming into the equation as well. The Chinese currency has backed up a bit as well. And that will certainly be a very interesting play after the election as well. We haven't really spoken too much about that. And of course, some of it is hypothetical, but clearly, whichever candidate comes in, they're not particularly friendly towards China. And if it's Donald Trump, it could be very unfriendly. So there could be some very serious tariffs going on the table there. And when you consider the way that the dollar yuan has come off the highs that we saw earlier in the year, there's certainly room for a decent play in that. If investors get really excited about restrictions against China. So I think we will see a lot more volatility in the Chinese currency in the last couple of months of the year.
And speaking of vol, of course, vol ahead of the U.S. elections. Let's talk about yields, how that may be impacted. We have the question of the day that we're asking our guests today. Will yields be higher or lower after the U.S. election?
I would say, I mean, if with the 10-year now is roughly 4%-ish, 4.2.
They're all about 4 now.
Yeah, 4 is the big number. I would say we probably drift a little bit higher. I can definitely see a return of term premia into the long end of the US yield curve, particularly post-election. So I would say probably on balance just a little bit higher than where we are now.
All right, Peter, hang tight. Bloomberg Analyst Strategist Mark Cranfield, thank you for joining us. Peter Kinsella of UBP will be sticking around. Well, still ahead this hour, the man who pushed the Tata Group onto the global stage has died. We'll take a closer look at Ratan Tata's legacy and what comes next for the conglomerate later this hour. Keep it here with us. This is Bloomberg. Well, risk back on for China and Hong Kong markets. Let's get to April for the very latest. April, we're seeing gains being extended here.
Yeah, some, but note here, this is also a mainland market that has been changing direction for much of today. You get the sense that investors are really watching out for the final piece of the puzzle as far as stimulus is concerned from the Chinese finance minister at 10 a.m. Saturday briefing. Maybe that will fill in the blanks, but amid all this, we have actually seen some of our M-Life strategists pointing out in terms of the CSI 300 levels. If you take a look at the daily trading volumes and how that is surged, that suggests to some that we could have seen that near-term peak being put in place. The other thing is for equity bulls that they might be looking for that bottom above the 3,500 level. But as you know, Haas, this is also an event of sorts that could underwhelm investors. There is a really real risk that it disappoints yet again. So flip the board. I wanted to show you how positioning is amid all this as well, as investors are ramping up their bearish bets on China, at least as far as one of the gauges is concerned, and that is the volumes of the leverage Hang Seng China product of the CSOP. So that gives you a sense of how investors are positioning going into Saturday.
Wow, trepidation when it comes to that finance minister press today. April Hong, thank you. Let's get back to Peter Kinsella, Global Head of Forex Strategy at UBP. He is still with us, and gosh, it's so hard to meet expectations because expectations are so high. Yeah. You got to wonder whether the finance ministry can really do the job.
Yeah, I mean, they've done a lot thus far, and I'd say
but still not enough, Peter.
Not enough, no. I mean, I think the broad consensus, I think, if we listen to most analysts and so on, is that they've done enough to improve sentiment somewhat. Definitely trying to improve sentiment, particularly in the housing market. That's all good. The game changer really would be doing something on local government debt, getting that off the balance sheet, and trying to essentially sort of recapitalize some of what we have there. So that would be the game changer, but that's a really, really big bazooka. Now we're getting there, right? We're seeing further incremental stimulus, but whether we get there to where we need to be in the short term, I'm not so sure we will.
People talk about whatever it takes moment for China.
Yeah.
What is that whatever it takes? I mean, you've suggested before that it takes QE, and that QE isn't likely to come.
No, I mean, it would be QE with Chinese characteristics would be the best way to put it. But I think I'm personally a bit skeptical about this policy maximalism that we see, whatever it takes, everything always has to be bigger and larger than expected, etc. Because there are trade-offs in any policy, right? The way I think about what China is doing is that they're basically, I think, truncating the left-hand tail of a distribution. They're making sure that the current situation doesn't get worse, right? But I think we can kind of forget about fiscal stimulus, as we've seen post-GFC, right? I don't think that's going to be the case. So really from here, it will be, we'll see further rate cuts. I think I'm pretty sure of that, and that's going to come. Whether it comes quickly or it's going to take time is another day's work. But what we're seeing at the moment is definitely a policy pivot. The question is how quickly they're going to continue that pivot.
And if it's China characteristics, it's probably going to take some time. The question also is about how the property sector turns, because I think that the recovery of China hinges on the property sector.
For sure, for sure. And what we know about when bubbles burst is that they take a long, long time to heal. You know, we saw it in Europe. It took, you know, at least 4 to 5 years before we saw sort of a plateauing in activity and so on. And, you know, it'll probably be something similar in China. We do have a huge overhang of unsold properties and incomplete properties as well. That all has to be dealt with. And then you've also got to sort of, you know, get liquidity back into the system. They're doing all of that, but at different times and at different stages, and, you know, some more quicker than the other. But it's what we've seen the last 2 weeks is the first step in the right direction, put it that way.
First step in the right direction. Yeah. Is it enough for you to pivot and be more interested, be more attracted to Chinese assets?
I would say no. You know, as a bank, I don't want to say skeptical, but we, you know, we just don't like the overall risk-reward characteristics as a rule. Certainly, what we've seen in the last 2 weeks, as you know, shows signs of improvement. That's all well and good. But there's a much broader issue of I would say, much wider range of issues that would have to be addressed before I think you see institutional, international investors getting back involved in China.
What does it all mean for the Chinese yuan? We've been talking about how the dollar has remained resilient. How much pressure is that having on the Chinese currency?
So if we look at, you know, the RMB basket, it's still trading at reasonably, you know, solid levels. I think when we look at it, the PBOC puts a huge emphasis upon sort of yuan stability. You know, it's a really, really significant policy anchor for them. And for that to change, it would only come as, I would say, a part of a wider, I would say, reconsideration of priorities, right? More domestic, less international, etc. And perhaps one of the reasons we saw the stimulus last week was that maybe that was the policymakers looking at a November election in the States and saying, okay, if we're going to get tariffs, we should probably act sooner on the domestic front rather than later. Because if we look at it from the trade perspective, China's doing absolutely fine. You know, we see record trade surpluses, everything is going very, very well there. It's really the difficulties on the domestic side of the economy. So for the yuan, look, I would anticipate, again, much of the same broad stability mandate without too many changes in the short term.
And that means that the other Asian currency is going to be pretty stable too, because a lot depends on the Chinese yuan.
Oh, for sure, for sure. Yeah, I wouldn't imagine huge vol. I think there's certainly with the BOJ, they seem to have taken the vol out of the currency, and we don't see huge moves, at least post-July. And again, from here, I think BOJ will continue gradual rate hikes, very, very well forecasted. So no huge vol there.
All right, Peter, thank you. Peter Kinsella of UBP. Do come back soon. Plenty more ahead. Keep it here with us. This is Bloomberg. And you're looking at live pictures from Florida as Hurricane Milton has made landfall as a Category 3 hurricane. Top winds of about 125 miles, that's 200 kilometers per hour. It is expected to carve a swift, destructive path to the Atlantic Ocean, and a lot of damage there from Hurricane Milton. For more, let's bring in Bloomberg weather reporter Mary Hui. Mary, what's the latest there?
Hurricane Milton has just made landfall as of about 3 hours ago, local time in Florida. It came on shore at Category 3. And even as it was moving towards Florida, its intensity has fluctuated a lot over the past couple of days. It was Category 5 for a little bit, dipped back down to 4, then back up. But as I just mentioned, it's come ashore as Category 3, and that's since the winds have since weakened slightly to Category 2 to make it a Category 2. But the fact of the matter is that it remains a very damaging storm, packing extreme winds, heavy rainfall, and life-threatening storm surge all along large parts of the west coast of Florida. So we're keeping a close watch as to the effects of the storm as it continues moving inland and across Florida and later on out through the Atlantic.
Mary, talk to us about the potential damage here. We know that, for instance, ocean water in Tampa Bay expected to rise as much as 15 feet.
That's right, and what makes this storm here particularly damaging is that Tampa Bay has a pretty low topography, so the rise in water level will cause large damages across a large area, and that's not the only thing we're looking at. There's also the fact that its wind field of the storm has grown considerably over even just the past 24 hours. So now tropical storm force winds extend over 200 miles from the center of the storm, and that means that there are larger areas in Florida that will be affected by the damaging winds, in addition to the heavy rainfalls and of course the flash flooding that may be caused by it. And so the National Hurricane Center now has an alert for the Tampa Bay area, including the cities of Tampa and St. Petersburg, warning against flash flooding.
And Mary, we're also expecting power outages that could last for weeks, right?
Potentially, and Hurricane Milton comes only, about 2 weeks after Hurricane Yellen. Utilities are only just now getting back up and running and have to face the destructiveness of Milton now. So as of this evening local time, close to 2 million, I think, homes and businesses across the state of Florida are now without power. The state of Florida is ready to send out workers to try and restore power, but as to how long that will take, I think remains to be seen.
Mary, thank you so much for that update. Bloomberg weather reporter Mary Hui. In the markets, we're keeping an eye on Chinese brokers, the likes of Guotai as well as Haitong A&H shares. That's on the back of news that they have proposed a merger to create a state-backed brokerage with $226 billion in assets, and that's to compete with Wall Street firms expanding in the country. Guotai Junan Securities currently surging by about 66%. We have Guotai Junan Securities currently up by about 10%. Take a look where Haitong is trading right now, in excess of 90% as we speak. Again, Guotai Haitong Securities shares soaring as trading resumes after they unveiled the terms of their proposed merger to create a state-backed brokerage with $226 billion in assets. Well, still to come, India's central bank in focus, opening the door to its first rate cut in 4 years after shifting its policy stance to neutral. We'll be discussing the outlook with Nomura's Sonal Varma next. Keep it here with us. This is Bloomberg. China in focus, and stocks there extending its rally today. Let's do a check-in on how exactly they're doing. Avril Hong in the Lion City. Avril.
Yeah, we are seeing those Chinese equities, along with the ones in Hong Kong, managing to build from some of the gains earlier in the session. But keep in mind, the event to watch is obviously what we're going to get out of Saturday's briefing from the Chinese finance minister. And at stake here, of course, as we've looked at the past 20 days and how much has come into the markets, just based on ETF flows alone, $11 billion. That is what could be at stake here. Keep in mind as well that the real risk of potentially that event disappointing is one that market investors are certainly keeping an eye on, not just stocks that are climbing. We're also seeing gains in the Chinese currency. And indeed, as Hong Kong heads into this long weekend, perhaps something can be gleaned from the timing of the PBOC today, announcing that eligible investors will be able to apply to tap into their $70+ billion liquidity tool, maybe smooth things in terms of sentiment on a little. Let's take a look at how the rest of Asia is faring today. We did see the S&P 500 clocking, what, 44th record this year, and we are seeing Japanese equities partaking in that just a little bit. The yen has also snapped a bit of that weakness that we've been seeing of late, pulling a bit stronger. We are keeping an eye on the US CPI, of course, that could shape the Fed monetary policy in the months ahead. We did get those Fed minutes. It doesn't look like a committee that is rushing to cut rates. One of the companies in Japan that we're keeping a really close watch on today, 7&I, we will be paying attention to its earnings, perhaps more than usual, after Canadian firm Couche-Tard came up with this higher buyout offer, and the CEO of the convenience store giant is going to be under pressure to show that the business can command indeed a higher valuation. From Japan, let's take you to India. Of course, yesterday we saw the RBI keeping rates unchanged. This was certainly as expected, but there were low expectations of a change in stance from hawkish to neutral. That is something that we got, and certainly that was helpful for markets overall, positive in a sense. It helped to pull swaps rates as well as yields lower in India. We are seeing a bit of a move on the 10-year now. Rupee, I believe, is still holding a bit steady today. Has.
Finally, we're closer to that rate cut for the RBI. Avril, thank you. Our next guest was one of the few economists who predicted an RBI rate cut this week. She expects 100 basis points of cumulative cuts in the easing cycle. Let's bring in Sonal Varma, Chief Economist for India and Asia Ags Japan at Nomura. Good to have you with us. Finally, right? Light at the end of the tunnel. We can now say that perhaps a cut is imminent.
Well, we think so. I think just taking a step back, there's a lot of noise in the headline inflation in India. And if you remove that noise, you'll see that the underlying inflation is actually anchored closer to 3.5%. And there are early signals of growth momentum softening. So given that monetary policy works with lags of 3 to 4 quarters, we do think it's time for the RBI to begin its rate cutting cycle.
Is there a sense that the RBI has held rates for too long? It should have eased by now.
Well, there have been lots of moving parts, both domestically in terms of food inflation shocks and sort of global uncertainties. In fact, in the run-up to this meeting, you had the Middle East tensions, oil prices moving up, uncertainty around China's stimulus. So a lot of factors that have held the RBI back. But we do think now is about the time, as Jay Powell said, the time has come.
So when we say the time has come, are we looking at a cut in December or?
So our base case is the easing cycle will begin from December. I mean, we had expected a cut in October itself. But importantly, we think it's going to be a long easing cycle. I think generally the consensus is it's going to be a shallow 50 basis point kind of a cut. But the momentum we are seeing both on inflation and growth do not suggest it's a shallow easing cycle. So we think it's going to be a 100 basis point in total cuts. Now, just in the run-up to the December meeting, we will have higher headline CPI in September and October. But I think, by December, monetary policy will be a lot more forward-looking rather than look backward-looking on the data.
You talked about how growth would justify that longer easing cycle. The thing is, we've been expecting a slowdown in India's growth for some time now, but we have yet to see a sharp downturn in its GDP or its growth. I mean, what do you make of that?
So we have actually started to see signs of growth softening. So in the April-June quarter, GDP was in fact 40 basis points below the RBI's projection. It came in at 6.7%. And the July-September quarter, actually most of the high-frequency data ranging from PMIs to GST to auto sales are suggesting a fairly soft momentum in this quarter. So there will be some pickup in momentum in the next 2 quarters because government spending is going to pick up. It was held back because of elections. Rural demand generally is doing fine. But on the whole, we think the financial year will end up with GDP growth of around 6.7% compared to the RBI, which has retained its projection at 7.2%.
I'm taking a look at the RBI's FX reserves. We're looking at $700 billion US. The rupee has been pretty stable. What do you think? What would make the RBI worried when it comes to these FX reserves levels?
You mean what will make it stop?
Yes.
So I think there's no limit. Because, as a country, nominal GDP is growing at 13%. So if you look at it as a share of import cover, you will still need higher reserves. And importantly, RBI is using these reserves as the first line of currency defense, given we are living in this new normal of elevated uncertainty and volatility. So we do think this strategy of building FX reserves is likely to continue.
We know that Governor Das, his term ends in December. What do you think will be the next course of action for the RBI, with or without the governor?
In terms of the
policy.
Mm-hmm. So, the broader policy direction will be driven by the macroeconomic outlook. And when the RBI meets in December, we think there'll be further evidence of softer growth than what the RBI is expecting, and further confidence that the worst in terms of the inflation outlook is behind us. In fact, even in October, RBI is projecting 1-year forward inflation at 4%. So we are at target. We are sitting at 2.5% real policy rates, which we think is above the neutral setting. So the macro conditions actually should reinforce an easing cycle ahead.
The thing is, the rest of the world is looking at the Fed. Expectations are perhaps another 50 over the course of the year. What if the Fed surprises with just one 25 basis point cut? Might that have any impact on how the RBI thinks about its own trajectory?
So, within Asia, RBI is one of the central banks that is less driven by the Fed, unlike, let's say, Bank Indonesia. So even a 50 basis point really didn't move the RBI this time. We think ultimately the decision will be driven by domestic growth inflation dynamics. Of course, Fed policy is an input, but if we have softer growth inflation signals, RBI should still go ahead and move on policy.
You would think that the RBI would also be driven by oil prices. We've seen
Definitely.
How oil touched $80 a barrel, and there are expectations it could get to 100 if Israel were to perhaps attack Iran's energy facilities. I mean, what assumptions are you making about the possibility of oil impacting the RBI's course of action?
Extremely important in the RBI's assumptions. So right now they are assuming $80 per barrel. And we are sitting closer to 80 after some of the geopolitical risk premium has been built in. So actually global demand has been softer than expected on oil. But let's say a scenario of $100 per oil changes a lot of the maths for India's macro. So that will be a constraint on the RBI. I think right now the assumption is that softer demand would mean that oil prices are not going to go through the roof.
One final question before you go. A lot of assumption on growth hinges on India being able to tap its demographic dividend, but we know there's been a lack of jobs, a lack of employment. How do you see India overcoming that challenge?
the process is underway in terms of government's focus on infrastructure spending, getting public sector foreign investors to invest, this China Plus One strategy, getting manufacturing to create more jobs. And in this particular this particular budget, there was a focus on employment-linked incentive schemes. So they're giving incentive to private companies, to skilled workers for internships. So I think it's basically this strategy of greater reforms focused on supply side sectors, getting more foreign money coming in, creating investment, creating jobs. I think that is the strategy we will see going forward.
Sonal, thank you for having your assessment here with us. Sonal Varma of Nomura. We're counting down to the open in India. We're just about 6 minutes away. Let's take a look at how it's shaping up to be for the Indian market as the rest of Asia is in positive territory. It does look like India will be opening in the money as well. The Sensex index pointing to a higher open, up by about 0.5% right now. In terms of the Nifty Bank index, it is up by 0.4%. We're also keeping an eye on TCS, which will be out with its earnings, and we'll be keeping an eye on Tata Consultancy Services, expected to report its latest earnings in the coming hours. Well, still to come, tributes pouring in for the late Tata Group patriarch Ratan Tata. More on his lasting legacy on the show next. This is Bloomberg. Former Tata Group head Ratan Tata has died at the age of 86. He was credited with transforming one of India's oldest conglomerates into a global empire through a string of eye-catching deals. For more, let's bring in our conglomerates reporter, Pierre Sanjay, in Mumbai. And Sanjay, we know that this is a man of global vision, and they say that global vision should be shared by India.
So actually, he was a visionary, and he was leaving a legacy behind. And Ratan Tata, the name, which could cut across to masses. And when he took over the chairman in 1991, that was the time when Indian economy was opening up. And you could recall the dream budget, given by then Finance Minister Manmohan Singh also. And when the economy was opening, he transformed. He rather reinvented the Tata Group, and he also made Indian entrepreneurs to think big and beyond Indian borders. And he's given that due credit to make Tata truly a global MNC. And you could see that now the revenue is more than half of the revenue is coming from international borders. So, and he took bolder bets. He made bolder acquisitions. He made leverage buyouts, and he made the iconic acquisitions like Chorus, Jaguar Land Rover, Tetley, and he made a new energy, and he made Tata truly a global one. It was, of course, immediately after independence, Tatas were more instrumental in nation building. But once that was done, when the economy is opening up, he just leveraged upon that, and he made more steroids into the Tata Group. And even then, after stepping up also, he made sure that the conglomerate is getting to the new age business. Like there was a super app, there was semiconductor business, he was also making the iPhone parts, etc. So he kept on transforming, kept on reinventing, leaving a big legacy. He was like a truly visionary. He could cut across the globe and across the masses who wouldn't understand business. So that was Ratan Tata.
Sanjay, talk to us about the impact he's had on the global stage. We talk about how he brought India to the world.
That's the right thing. He actually brought India to the world. So he made bolder bets when he set order back in order in the home. He started focusing on global arena. He wanted India to be exposed to the global opportunities. That's when he bought Tetley, which was and then he bought the Daewoo Steel plant, and he made a bolder, even iconic bets like Chorus, and he also bought out Jaguar Land Rover, which became like case studies for business schools for several years. And he did not leave. Earlier it was like Indian businesses were really conservative. They would conserve cash, and they would always think that heart is where home is. But he said the home is like global, the global arena. He embraced the global opportunities, and he went on buying, making acquisitions, which actually got synced well in with this conglomerate, which is salt to software conglomerate. And if you carefully see that there was over 150 joint ventures, the conglomerate became really, really big, and it also helped in national building. At the same time, it dreamt big, and it crossed borders, and it made acquisitions, and it reinvented. It got challenged. It was not all acquisitions were like successful. He got challenged with the global challenges, yet he was waiting to take bets, bigger bets than like any MNC. So actually, it made he shown the Indian entrepreneurs to think big beyond Indian borders. It became a global. He instilled the steroid of being a global MNC, not just an India-oriented company.
Sanjay, tributes pouring in for Ratan Tata. Tell us more about that.
Sorry, I didn't get the question.
We know that tributes are pouring in for Ratan Tata. Tell us more about that.
Across the sector, Mukesh Ambani was like quick enough to say that kind of a visionary, how he had inspired, Ratan Tata has inspired Mukesh Ambani. Most recently, like Kumar Mangalam Birla, the chairman of Aditya Birla Group, is also telling how he was been instrumental in shaping the dream of India. So across the domains of the Indian INC, because they all saw how a conglomerate is shaping up the dreams of India. It is not the purely business. If you could see, they are all inspired by the ethos and the values instilled by the Tatas into the business. Business never got its due, to be very honest, but Tatas made sure that business also got that kind of value, ethos. It is not that, and of course, he's one of the renowned philanthropists. That philanthropist nature, the ethos, the values, the moral, issues, the mission, the vision was all instilled into the business ideas as well. It is not purely making profit, but it's also, he thought about giving Tata Nano. Tata Nano was not like a hugely successful project, but he wanted his fellow countrymen to travel in a car instead of using a motorbike, which is more dangerous, carrying 4-member people in a two-wheeler. He dreamt about making a affordable car, which is Tata Nano, and he also made affordable hotels for Indian couples, Indian middle class to live in. So he thought beyond business, he thought beyond profits, yet he never left his ethos and moral values to the business sense per se.
Sanjay, thank you so much for that. Our conglomerate reporter, PR Sanjay Mumbai, on the passing of Ratan Tata. Taking you to markets right now, India's been trading about 3 minutes. As we speak, it is in positive territory along with the rest of the region. We're seeing gains from the likes of Larsen Toubro, which is the biggest advancer at the moment. The Sensex index up by about 0.3%. Worth noting that Bernstein has got Indian stocks to underweight from neutral. We've been talking about that overstretched valuation in India. That's prompting Bernstein to cut India to underweight from neutral. It talked about record high relative valuations to China as well, and emerging markets, high crowding risks as well as earnings cycles that's heading towards a downgrade for Bernstein. Plenty more ahead. Keep it here with us. This is Bloomberg. Tesla is taking off the wraps of its long-delayed robotaxi later Thursday. Tesla's new product will face tough competition in China, where self-driving taxis have moved beyond trials and onto public streets. Our Chief North Asia correspondent Stephen Angle reports from Beijing.
Already dominant in their home market, Chinese EV makers aim to lead as well in the self-driving realm, from advanced robo-taxis to larger semi-autonomous semis.
The game for autonomy is in China. That's why Elon wants to roll out his own FSD there.
Tesla, along with its Chinese navigation partner Baidu, plan to make FSD, or full self-driving, available in China by as early next year, pending final regulatory approval, after getting an in-principle okay from Beijing in April.
It's a watershed moment, and this unlocks a golden opportunity.
At least 9 domestic Chinese automakers, plus smartphone giants Xiaomi and Huawei, among others, have a head start, though, locally through real-world traffic pilot zones in multiple cities across China, seeking a leg up in so-called ground truth data.
At the moment, the local knowledge gives them the advantage because, again, the scale. The scale is uncompared to anywhere else in the world. But as Tesla leans on that scale, as you mentioned with the Baidu cooperation, that is slowly going to be eaten away over time. And unless they can also do that kind of data gathering outside of the country, Tesla will at some point not only become competitive, but may ultimately become a market leader.
I think Tesla's full self-driving is great. I like it too. But FSD's breakthrough only took place in the past 12 months. I think Xpeng's XNGP and Tesla's FSD can both perform well in the global market.
Tesla is indeed a pioneer, but everyone is beginning to get closer. Chinese car companies have a better understanding of the needs of Chinese users and the needs of China's road conditions.
This is a pretty narrow road. You can see all kinds of different scenarios like bicycles, pedestrians, vehicles cutting in, cutting out.
Toyota partner Pony AI has been real-world road testing its robo-taxis for more than 6 years. So we hailed a ride in Beijing.
Tesla's FSD coming into this market, is it a threat?
It's definitely a good thing. More competitive this market is, it means the better products will be offered to the customers. We need to have the customer acceptance. That is very, very important. The customers have to trust this kind of technology.
Oh, whoa, wow, what happened?
Somebody pulled out suddenly.
Oh.
The brakes work.
Safety and certainty are clearly important as well for another electric vehicle industry in China, in the so-called low-altitude economy that includes airborne EV delivery of packages and passengers. Yihong is perhaps the most well-known of the Chinese air taxi makers, but Volant Aerotech 2 hopes to have its $2.5 million VE25 certified by mid-2026 as China opens its lower airspace to piloted and pilotless eVTOLs, or electric vertical takeoff and landing aircraft.
There's a huge potential in this area.
Electric vertical takeoff and landing commercial drones come in many shapes and sizes, and they are throwing lots of money at it.
So much so that at least 20 provinces say they intend to build out their own low-altitude economies.
The vehicle itself is carbon fiber, and it's generally produced all domestically. The battery ecosystems which they use are here. So all of the ecosystems and manufacturing is already located domestically. So that actually gives it a huge edge over any competitors.
Now is a little bit challenging time between China, Europe, and the States. I think it's important to have the communication and not afraid of everything. We are trying to build this aircraft for the world.
The next real test for autonomy, both in the skies and on the roads,
it's all down,
will be to see whether customers are afraid or not to get on board. Stephen Engel, Bloomberg News, Beijing.
Let's take a look at U.S. futures, see how they're shaping up ahead of the CPI print in the U.S., which has become even more crucial on the back of that better-than-expected jobs data. We're seeing a flat future S&P futures on the back of a new record high overnight. We talked about how the CPI print is crucial. That sent a repricing of the Fed's trajectory, of course. U.S. Treasury yields, by the way, have risen as traders have cut bets on additional Fed rate cuts. In the broader market, this is how it's looking for Asia, getting a lift from that U.S. Another record high overnight. Hang Seng up by more than 4. China CSI also up by about 3. That is it from Bloomberg Markets Asia. Horizons Middle East and Africa is next. This is Bloomberg.